Bitcoin breakout or fake out? Good morning, guys. It's Keith Allen, and we are ready to get into it as we've got some more movement in the order book and some changes that are really putting things to the test here. We're going to take a look and see if we can analyze things and see how these short-term moves might impact the macro outlook. First, we want to figure out how to fade out of this music because, geez, it's loud, but it won't go away. Hold on a second, guys. Bear with me. It's been that kind of morning. That's all right. I'm with you. I got this. Don't worry. I can handle it. So let's yeah, that was a smooth fade, right? Let's just start jumping in and check things out on the candle chart, because we've got a structure that has been developing here. We've, looking like we have a potential breakout. That breakout is being tested today. Could be as soon as today, where we test it and validate and maybe get a confirmation or perhaps invalidate that retest. So let's start over here. No, that's not where I want to be. Actually, let me go to this chart, and that will get us in place. Here we go. So let's go with this one right here. We'll start on the candle chart. And as you can see, we have this falling wedge, and you can see it on the 4-hour chart and on the D chart. I'm looking at the daily chart here because it reveals some important correlations or confluence, if you will. Looking at the downtrend line here, this is the upper side of this is obviously the upper end of the structure. We have a falling wedge here, which is historically a bullish structure on these breakouts if they can indeed validate, right? So we're coming in for a potential retest or test, I should say, of this support level. At the top of the trend. This would be an RS flip or resistance support flip. And notice how it correlates very tightly with the 100-day moving average. So, a wick below the line wouldn't bother me so much. A wick below the 100-day moving average would bother me more. That, in my opinion, is the stronger technical support level. And so, and lines are subjective. So, maybe they end up right here. Maybe tomorrow they're intersecting. Who knows how this is going to develop, but you see a very tight range here. It's the 21-day moving average overhead, the 100-day moving average below, which is, at the moment pinning or compressing the consolidation range. And that's something we talked about yesterday. I wanted to see things consolidate from such a wide range down into something that seems to be more manageable, more of a more precision consolidation range, or a tighter consolidation range, if you will. And quite frankly, Bitcoin has been trying to find that since we had that low back in early March of around 59K, and a high of 73,800 or so. That was just too broad of a range, in my opinion. We never held up above. We were looking to maybe get a consolidation above this 2021 top. It never happened. We had all that weakness. It broke down, and now we felt like this could have held, but it didn't. We had this breakdown at the end of the April candle. Things broke down, so we got a lower low here, which now sits at 56,500. I was actually anticipating this to go to 55K, but here's where it stopped, right here on this trend line here. So that is technically the bottom of the structure and a good support level. 55K was a good support level, in my opinion, at the time. And obviously over time, these trend lines, they, where support is, changes relative to the trend line, right? Over time, things move. So here's where I have concern here, right? So number one, we would want to see this level hold, which at the moment is happening. And of course, that needs to be followed by a legit break above this 21-day moving average, which has yet to happen, right? Weakness, weakness, weakness. All these wicks below are representative of weakness, in my opinion. And when that happens, the breakdown is, apparently seems imminent. So if this does validate as a breakout, which means we hold this test of support here. And I personally like to see 3 tests of support. So this would be one. This, if we get down a little further down to that, that's at the 61K, currently around 60, just above 61, 300 or so, and then the 100-day is just above 61. So let's call it 61K, just above 61K. If this holds, that would be a second retest for me, and I'd be good with that. And then of course we need a stack above here to figure out what the potential upside to this is. We do what's called a measured move, where we take a line, a vertical line from the pretty much the highest part. Oh, wrong. That's the wrong deal right there. From the highest part of the structure. This is pretty much the width of the gap right here, right? So a measured move from here to, say here, puts us above 71K, if that were to indeed, happen for us. So a lot of time between now and then for that to develop, but this is a bullish case scenario for this move. It would also position us to attempt an RS flip above the 69K level, which of course is the 2021 top. Now let's look at worst case scenarios if things break down further. And for that, I want to look at the weekly chart, because this also reveals something important here. And that is the 21-week moving average, which in my opinion is the strongest and most important support level on the chart. Even though it's above the structure here, right? And the structure not exactly the same here on the weekly. It is indeed a lower time frame structure in this scenario. At least at this point, I see it very clearly on the D chart, and I see it very clearly on the 4-hour chart. So those are all, that's how this shapes up for me. You may see something different. This is what I see. So if we go to the weekly chart, though, not really so much concerned with the structure as I am concerned with this moving average. Unfortunately, it's above the support line on that structure. So that's at 56. That's at 56K. Remember, this candle right here is at 56,500. So if we did go all the way down to 56K, that is at this, if it happened today, that would create a lower low. Now, by over the next few days, by next week, which is in, a few days in terms of candle terms, this could be moving up, right? And so then it could potentially be a higher low, and a higher low is what we need to see if we want to start digging out of this range here, right? So at the moment, 56.5 is the local support. A higher low is obviously a better case scenario, really, quite frankly, the best case scenario that we could look for. A retest down here of support would be, in my opinion, something that we need to see happen before we get that real breakout to a new all-time high. And that could indeed take time. So we could conceivably consolidate in this range further. All of these things can still happen, and we could still not be breaking new all-time highs, right? This could be a bullish structure. This could validate as a falling wedge. We could get this measured move, and then we could eventually, come back down and test this level of support. If it holds, we consolidate above here, then we can talk about going after this all-time high. And if not, well, guess what? We drop back into this range and we start over and potentially retest this support level again. So that's really the long and short of what I'm looking at here in terms of how liquidity looks in the chart relative to that and other things really impacting the market. We can first look over to the ETF flows. And this reveals something I think that's very important, because it seems like the market seems to get very, kind of black and white, very myopic over the ETF flows. Obviously we had a big sell-off here at the monthly close. They were kind of trickling their way out, waiting to see how things were going to develop. There's a big sell-off across the board with all of the ETF classes on May 1st as the result of that dip down to, the mid 50s. Now, notably, this happened right here was the monthly close. And guess what? They got caught. They got caught in between hours when this was happening, right? And they couldn't really, the ETFs aren't nimble enough to be able to do this because they only trade within those restricted TradeFi trading hours. So this, obviously, the advantage goes to the crypto traders on spot exchanges who were able to take advantage of the wick down to 56.5. And so now, since then, we saw some news on that following Friday. Obviously, we had Jay Powell's speech that day, and then we had economic news on that Friday, and we saw for the first time ever on the 3rd, we saw the first day ever of positive inflows for Grayscale. This was a big deal, and the market said, "Oh, we're off to the races. Let's go." Well, we did pump for a couple of days, but guess what? Things have leveled off yesterday. Why? I'll tell you why. Because up only is not a thing, right? Because these institutional investors are maturing and starting to realize that what they did initially with all of that pent-up demand was drive price up at a rapid rate. They were literally their own worst enemy for the first few months of this. And then things started to level off. And now they're trading more correlated, I think, with the market, albeit they have that lag effect of not being able to deal with what's happening in the overnight hours. So nonetheless, a flat day for many of the ETF holders. Looks like Fidelity was again buying yesterday, but BlackRock went back to selling yesterday. Not a lot now. Okay, so we had talked about the fact that this selling trend seemed to be tapering off as it did. And so we got this, we got a couple of candles slightly above. Hard to see some of them because they weren't very big. But so one candle below does not make for a trend, right? So we need to see how things continue to develop. But I think it's safe to say that they're starting, the bleeding has certainly slowed at Grayscale, and that these ETFs are trading much more closely to the market than they were in the very beginning. In the very beginning, it was like, they had that big sell-off initially, and then the market was really just fueled by the ETF demand, and that pushed price up, and we rode it, and we're happy to do so, and kept piling in because things seemed to be just screaming upward. Well, now we're seeing the corrections from that. Also, something to be mindful of is, what's happening on the economic calendar. Obviously, we saw a bump in the unemployment number on Friday, which helped lead to the rally that we've been experiencing through the weekend, and now seems to be tapering off. One of the things that we'll look at tomorrow is we have a round of jobless claims coming in. And I said the other day that, it's weird how the jobless claims never seem to correlate with the unemployment numbers. We're going to find out soon. Tomorrow, of course, we have another report with jobless claims coming. If that should be a hot report, the market will respond well to that. That would be one of those bad news equals good news scenarios, because it feeds the narrative of the fact that the Fed could conceivably cut sooner than later. Really, we're not on a tight timeline at this point. The Fed is just looking to see more progress, and that progress had stalled over the last month or so. And now, with the introduction of an increase in unemployment numbers on Friday, that's a sign that maybe we're not stalled out, and we'll see continued progress. A lower or a hot jobless claims report would indicate continued progress in the right direction, whereas a strong jobless report, meaning not a lot of jobless people, or not a lot of, or a reduction in continuous claims, especially a large miss, would signify strength in the market, and that, well, the Fed has more work to do. So we'll be keeping an eye on that, of course, as well. Might turn out to be a nothing burger. Big miss is a big deal, in my opinion. And of course, we always take a look at liquidity in fire charts, and we can see that we had some movement around here in the order book, where liquidity has been moving most significantly, or most importantly, in my mind, this block down here in the 50 to 52K range that moved up here up to the 58K range is important, because it could insulate further this 55, 56K level that we're trying to protect, so that we do not break this trend line, or most importantly, break the 21-week moving average. That's what I'm looking at for now, guys. I hope that gives you some insight and helps you understand, excuse me, some of the things that you need to be looking for here in the market. And listen, I think those of you who have been watching for a while have figured it out. I do my best to remain unbiased and show you guys the possibilities in both directions because I think that is super critical to helping you trade. It's certainly how, what I'm doing. And I'm not giving you guys any advice. I put the disclaimer up at the beginning. No advice here. I'm just showing you how I trade and how I interpret the market. And I hope that you find that helpful. For me, knowing the possibilities in both directions and managing risk is how you play the game. It's how you succeed in trading for the long term. And I hope I'm helping you do that. If you do like the content and I am helping you out in any way, shape, or form, please do me a favor, smash all the buttons, help me grow the channel, and share a comment, please. I love the comments. I read each and every one of them, and I engage with you guys across all the social channels. So I appreciate that. Once again, I appreciate the support and the feedback. You keep it coming, and I'll keep it coming. With that, I'm going to wrap this one, guys. Trade safe, and as always, have a great day.